can't help but be positive for Apple, I assume. But where's the risk for Apple?
The Google revenue share. Welcome to the Telltales podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace. Along with our co-host Hunt Lawrence, aka Mr. Cashflow, we're here to explore how cash flow drives the economy and investment performance.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
First thing is oil pricing. We always do Exhibit C first. I would say the problem now, because oil has started to weaken, is that 4.4 million of excess production capacity that isn't being produced in 24, declining to 3.5 next year. About 1.5 million of that is voluntary by Saudi Arabia and the United Arab Emirates. And they may start to feed half or more of that oil into the market in the fall. And that will cause the near months to come down. On Exhibit B, you can see there's a fair amount of backwardation in the market. In other words, last Thursday, price of oil, WTI was 76, and the price of oil in 26 was 69. What may happen is the near months may come down, but the 25, 26 price may persist. But as we said last week, probably not the right time to start a position in an oil producer or a natural gas producer. Natural gas, we have this extraordinary situation where Henry Hub gas is trading for under $2. Citygate price, even in California, is trading very low, like under $1. And there's just too much gas. And if you own a contract for September delivery and there's no storage, you have to sell the contract. So that just creates incredible, that's what causes these very low prices. As we get through this into the November, December, into the winter, it should be better, but you can't be sure of that. Exhibit A, Vice President Harris has had a pretty good first 10 days. She and Donald Trump are going to have to come up with something, some plan on deficits. I don't know that they're going to advocate cutting programs, but you almost have to. You have at least $500 billion of extra spending for all other as compared to pre-COVID. Some part of that $500 billion has to go. If Vice President Harris wins, they will extend the Trump tax cuts. So that individual income tax line will go up more than is predicted here, and corporate income taxes go up more. But more is like $200 billion or something. It won't begin to solve the problem. So that's a commentary on Exhibits A, B, and C. I thought one of the things we could do now is go through from page 20, and we won't cover these things, but I'll lead off and then Mike and or Jason can chip in terms of macro and how it affects the companies on each of these pages. Page 20, I really don't have too much. I'm a long-time holder of Five Below. It's hit a downdraft. The CEO has left. Hopefully, it's still a very good balance sheet, and I think fundamentally good business. Hopefully, it'll recover. Uber, Jason, AI and Robotaxi can't necessarily be good for Uber. How do you look at that?
Depends how it shakes out. It could be a very bad thing if Tesla does bring an Uber taxi to market and then operates that network themselves, and Uber is not a competitor in that they also have access to robo taxis and people can put their privately owned cars on the fleet and have them operate Ubers without the expense of the driver. So if they're left out of that market, obviously very bad, but it could be a really big thing for Uber. If you remember back, they tried to make their own autonomous driving program that they eventually scrapped. But if they can avoid paying drivers, that would be a big win.
Right.
But it might make that entire market more of a commodity market. The network's more important when it's a two-sided network than when it's a one-sided network, I think.
Right.
If you no longer are supply constrained, which is kind of what would happen in the event of a robotaxi situation, then demand really drives it. And I don't know that there's as much opportunity for the networks.
I think the flip side would be that, there'd be a lot more people giving up owning a car.
Yeah.
If access was a lot easier and cheaper.
Agreed.
Right. Page 19 is United Health. We won't even ask for a commentary from Jason. He's definitely yes. And I think he predicts that Lilly's valuation may be a little overdone from the weight loss drugs, which will become a bit of a commodity. Or am I overstating the case there, Jason? Or
I think long term, yes. There was something interesting in the news about the GLP-1 drugs, and I don't know which specifically they were using in this test, but in the UK, they ran a small study, I think 200 patients, and they were treating patients with a mild form of Alzheimer's. So the interesting thing is the GLP-1 drug also had an effect of slowing down cognitive decline. And the number they cited was they found it slowed down by 18%. And for context, the Leqembi drug study shows that it slows down between 27 and 31%, depending on which study. So it's a decent size effect, which is interesting.
Right. Right. Page 18 is copper, Freeport, lithium, and Albemarle, and ammonia and CF Industries or fertilizers, and NextEra Power. I just don't understand NextEra. They have a lot of debt. They do a lot of financial engineering. Half of it is a very well-positioned, well-managed utility, Florida Power and Light. The rest of it is NextEra has more wind and more solar production than anyone's, including Berkshire Hathaway Energy. But I just don't get it. I mean, it just doesn't work from a free cash flow point of view. Any other comment on these companies, Mike or Jason?
I'd just say watching the lithium market has been interesting. You remember lithium prices went through the roof through COVID, and now they're well back down to where they were pre-COVID. And that's it's a sign of two things. One, we had overly inflated expectations for the future of the EV market and how fast that future would come to be. And then you had a commodity market that works pretty well, tends to figure out ways to get the product to market. So more supply has come online, and that has forced prices to come down. So there's no surprises there, but it's been fun on this podcast to actually watch a full cycle.
Yeah, I would add about the supply side is, Argentina has been in the news a lot, and the best reserve of lithium is in the Andes Mountains on the border of Chile and Argentina. And right now, Argentina doesn't really exploit that, and Chile's the top producer in the world. So under the new government in Argentina, they're starting to look at large-scale production there, bringing in international players to mine that lithium. So there could be a lot of supply coming on the market, but it takes years to bring these mines online.
Yeah, it's true.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Everybody, it's Dawn Riley with Oak Cliff again. I'm not on a boat. I am getting ready for the Oak Cliff International that's coming up this weekend, and we have 11 teams that are going to be racing from all over the world. It looks like a really good competition. You're going to see people from Australia and from New Zealand and of course from America out on the water. We hope you'll stop by on Saturday, Sunday, Monday, or Tuesday. And our menu is going to be different themes every night between American good old hot dogs. We're gonna have a Mediterranean, because I just got back from Barcelona where I was visiting with American Magic and the Orient Express French team. And then we're going to have a Mexican themed Monday night. You're welcome to stop by Oak Cliff. But right now, I gotta get back to work as the executive director, because yep, I am at Costco. See ya.
And now back to the show.
The FedEx page 17, FedEx and UPS have the problem of competing with Amazon's logistics, which isn't a comfortable position to be in. Nike just seems to have lost its way. Costco is one of the great retailers in the world, and they continue to perform well. And of course, they're appropriately expensive. I mean, they trade for about 50 times free cash flow, but it is a very, very good business. Anything else there?
Well, there was some articles about Nike and about maybe some of the key decisions that they made that has led them astray. I think it was Wall Street Journal over this past weekend. So if you're interested in that, I thought that was a good article.
Yeah. It's a great company. I mean, it has a very strong balance sheet and good cash flow characteristics. Definitely is struggling a bit. The McDonald's and the other restaurant stocks and the hotel stock are page 16. McDonald's and Starbucks, I think, are struggling to have same-store sales growth. Chipotle just, they did have that problem with E. coli, but boy, did they come back awfully strong. Again, it's a very, very good company and appropriately very expensive, about 50 times free cash flow. Celsius, Mike and Jason own or have owned. Jason found it during COVID, right? You were doing an outdoor gym, and
Right.
he noticed everyone drinking Celsius drinks. So having built up a position, they have to kind of live with that position or build up their moat, so to speak. But what other commentary would you have on McDonald's, Starbucks, Chipotle, and Celsius?
Well, I'd say Celsius is cheaper than it is on this sheet. Celsius is down actually below $50 a share right now. And it's a sign of a number of challenges when you're a quickly growing company that's scaled into national distribution very quickly. So we're not totally sure. What we know is that they're lapping high growth in the past year. And so their growth rates have come down substantially. On top of that, they're rebalancing the amount of inventory that Pepsi carries, and that's a result of kind of the slowdown in growth and also adjusting to expectations for future growth. So those have kind of spooked investors, and I don't necessarily think it's a reason to sell, but the long-term outlook for Celsius is, and the question is this brand going to become are they going to, essentially the market is controlled by Monster and Red Bull. Are they going to tap in and grab a significant market share from those players? And they've done better than anybody ever has, any challenger in this market, reaching double-digit market share. And in some markets, they have north of 20%. So we think there's possibility for them to grow, but I think they're hitting some real growing pains now as a part of being a larger company with a larger reach and a larger brand and more consequences to any changes or actions that arise from it. Jason, you got anything else on Celsius?
I think you summed it up pretty well. And I just add that there's a handful of U.S. markets where they're at parity with Red Bull, and they're the number one energy drink on Amazon in their marketplace. So clearly the potential is there that they're going to compete on par with Monster and Red Bull. It's just if they can pull it off in the rest of the U.S.
let's do page 15 and we'll cover healthcare and then reserve the rest of the half hour for news updates on chips and software as well as healthcare. Mike and I were talking this morning, he said there was some Vertex news, which is positive.
Yeah, so we've been discussing that they had a rolling submission for their VX548, so their non-opioid pain treatment. They've completed that submission and the FDA has accepted it. So the FDA has all the data they need to make their decision, and they granted a PDUFA date of January 30th of 2025. So that's kind of the line in the sand at the FDA. They have to make their decision by that date. So it's good to have some clarity there.
What's the issue? Is it the effectiveness of the pain killing or side effects, or how would you characterize the issue?
They're going to look at all of that. I wouldn't say there's an issue. Some of the commentary in the market was that it's not as an effective painkiller as an opioid. And that's certainly true. It's in some cases on par, some cases slightly less effective. But the flip side is it's far and above the best non-addictive painkiller that will be available.
Switch back to page 1. Microsoft didn't meet expectations. I mean, the numbers look pretty solid to me, but there was some expectation, I guess, that results would be better than what was announced yesterday. But it still looks like a pretty well organized, healthy situation.
Yeah, I'd say the concern that most people have are related to how is this AI Copilot growth actually going? And I think the sales have come in on the lower end of the range, but they also indicated that part of the reason that that's happened is because of a lack of capacity. And that revalidates, it's actually much more, we got much more positive news out of the rollout of Copilot than anybody expected, but they were at the lower end of the range. So I think it's a fine line, but based on their comments, they say we expect capital expenditures to increase in the coming years to support growth in our cloud offerings and our investments in AI infrastructure and training. So they are, like Google said last week and Meta has said, they are going to continue to invest in these NVIDIA servers in order to keep their AI offerings growing. It wasn't really talked much about afterwards, but the way that they said that what they had said is that the limiter was the lack of capacity. That was really telling to me that things are actually going quite well.
Yeah, it was more upbeat than Google's call, where all the big tech so far, all the CEOs of the big tech companies have said the same thing, that they're going to continue spending on enterprise AI. Sundar Pichai at Google, and this is a quote, he said, the risk of underinvesting is dramatically greater than the risk of overinvesting. And they're all looking at it that way. Where Google didn't have a clear answer to how are you going to monetize all this spending, at least Microsoft said Copilot sales are starting to build. And they have they cited a number of groups that have purchased 10,000 plus seat licenses.
Didn't you people think when Copilot was first announced that if it was really taken up by like a quarter of Windows Office users, it would increase Microsoft's free cash flow by 15 or 20% or some rather large number like that? Have I got those parameters off? Or
A little bit, because I think we said they would increase it by 50%. And at the time, they were doing $60 billion in free cash flow. And today they're at 74. They've actually moved up pretty substantially. So we expect them to get to 90. And we have a target date on that that's the end of the decade. But that is dependent on a quarter of their current users taking up this AI offering. I think our data is a little bit stale because the pricing is a little higher than we expected it to be on the enterprise. And that sort of makes sense because there's more of a lift to bring enterprise data in to the network. So charging extra $30 is probably not sufficient. For small businesses, a $30 additional fee is probably about right. So broadly speaking, we're pretty comfortable with the forecast.
Jason, I have a question for you. I noticed JPMorgan said that they had developed their own language model. It's going to be available to mostly all employees for regulatory reasons. It wasn't on someone else's server. Are they like a NVIDIA customer using NVIDIA servers, or what do you think they're doing?
Yeah, highly likely. Yeah, they could be an NVIDIA customer and using NVIDIA's models, or an NVIDIA customer and using, an Anthropic or another AI specific company's models.
Facebook.
Or Facebook, yeah, the open source one. Yeah, I doubt from the ground up they built their own model. That's an incredible challenge.
There's no reason they would do that.
Absolutely not, no.
But the licensing that Meta has for their Llama model is such that if you have the technical chops in-house, it makes sense when you tick through your options. You worry about vendor lock-in with OpenAI or Microsoft or Google. So that leaves you with vendor lock-in with NVIDIA, which you're already sort of stuck with, or you go with the open source model from Meta. And I think more and more companies are choosing this open source model from Meta as the best way to home grow their own AI strategy.
Right.
And Meta just last week released a new model that some believe is the current state of the art, better than OpenAI's model. That's the 4.0 model that's out there, and it's free to use. And
what's notable is that they went in 1 year from the capability of GPT-3.5 to GPT-4.0. It only took them 1 year. It took OpenAI 3 years to make that same leap. So it's the pace of innovation at Meta is really incredible. I mean, it doesn't make much business sense, at least in the short term. The long-term vision for them, I have to assume, is a vendor lock-in. And they'll just keep releasing these models, and maybe slowly over time, they'll add more hooks to the open source. What is open source, and at what point do you need to start paying us for this model? And if you can have a 10-plus year time horizon, that's a great strategy. But most other companies, probably NVIDIA excluded, pretty much everybody else lives more in a quarter to quarter, or this year, next year, and the year after. Not many have the luxury of looking 10-plus years out. And that's really reserved for founder-led companies. And aside from Jensen at NVIDIA, Mark Zuckerberg's probably the most forward-thinking CEO that's currently doing anything in the space, other than Elon Musk. So it's almost no surprise that all these founder-led companies are doing the most interesting work in the long term.
Right. I may have misunderstood the JPMorgan release, but it looked to me like the material that was scraped to make your large language model was kind of every piece of information that JPMorgan has within its files. Is that just me misunderstanding what a large customer like JPMorgan using NVIDIA servers could achieve, Jason?
No, that's likely what happened. They would have, however, started with a foundation model. So something like the Meta Llama model that's understands English, or a handful of languages at this point. And then you would continue to train that on top of that foundation model. You would train your JPMorgan specific data, so that it would answer questions about any of the files that you've loaded in. And how you built that infrastructure that's probably custom to them. but it would be, you're starting at you're getting a much further head start using someone else's model and then retraining the last layer in the model on your own enterprise data.
Right. How, with OpenAI saying they're going to do search and Google trying to protect its search cash flows, how, Jason and Mike, how do you think it looks in 4 or 5 years? Will people still be mostly relying on search, or I mean, one of the articles I saw, Google was saying, well, there'll be enhanced search. So when you're looking for something, Google search, you'll all have access to a bunch of YouTube information, on the particular product or service or vacation spot or whatever you're researching. I mean, how do you think it looks in maybe 4 or 5 years is too long? How do you think it looks in 2 or 3 years?
I think it is more of a chat interface. And I think maybe some of the questions you ask will be, show me the top relevant articles for my question or a general search. And it'll either provide you a list or it'll provide you an answer with cited references.
So I'll push back on that a little bit, because where is the new data going to come from? Because most of this is reliant on user-generated content. So most of the social networks that provide user-generated content are closed to web crawlers, including Reddit now, except for Google. And that's probably going to be an antitrust issue at some point. But Facebook is closed to being crawled on the internet. All of these platforms, X.com, they're all closed to being searchable. And that, the downside, the worst case scenario is that the open internet dies in the process. And that probably is not good for long-term innovation for the internet in general.
And it's starting.
Yeah, and it's probably not good for search in general either, because what will arise from that are more Amazons. And if you think of Amazon as a competitor to Google, mainly because that's where people go to search for something to buy, more things like that will arise that will compete against Google, because Google will have less and less and less to essentially mine information from.
Right.
Yeah. I think the challenge too is maybe more related to advertising. I think the AI search solution will still have to push the user to the website that it's sourcing the data from. If it doesn't do that, the website won't exist. And as Mike said, there won't be updates to the model, and you won't have new answers that are relevant. If you don't push the user there and then they see the ads or however that site monetizes themselves.
I'll take the other side of that, is that you could embed the model to provide answers that are advertising based. And that would be really unfortunate too, because you'd be going for a source of truth that would actually be spitting back an advertisement. And that may be a reality that we see as well.
Google's not far from that. The first thing you see is a sponsored ad.
Oh, I thought the motto was do no evil. First, do no evil.
Yeah. I don't know if they dropped that or not.
Yeah, maybe de-emphasized it. We're talking 2 or 3 years from now, Apple's delayed their AI capability in their iPhone 16 Pro. What do you think we'll be doing with our iPhones in 2 or 3 years in terms of accessing large language models for information or entertainment or whatever, and how, this can't help but be positive for Apple, I assume. But where's the risk for Apple?
The Google revenue share.
Right.
Right? Because if today you pick up your iPhone and you search for something and you're doing a Google search, and tomorrow if you're picking up your iPhone and you're asking Siri and Siri responds with the answer, nobody's making money on that. Apple's not making money on it. Google's not making money on it. So it's not totally clear where the money's going to come from.
Right.
Yeah, I think the same thing. It seems to me there's a conflict of incentives between Apple's intelligence product and then the app makers. So if they want every app to be plugged into Apple Intelligence so that Siri can answer questions about something in the app or whatever they develop, but the app developers want you to open the app and look at it, interact that way so that they have more ability to monetize you by data collection or showing you ads or whatever. So I think there's a conflict there of, does the user end up in the app or just interacting with a Siri type product? So,
and maybe the end result is we all just pay money, right? So instead of being advertising based, these answers are subscription based, and that might be the right solution. But again, you go back to Google and what's Google's case. None of these things happen overnight. So just keep that in mind. Google's not going away anytime soon.
Right.
And Google may be the first one to come up with a subscription-based service that is an alternative to search. And you think about what Netflix just did by instituting a advertising-supported tier. They didn't do that because they're going to generate more money from the advertising tier than they will from the others, but it creates a baseline on which to raise further prices for the subscription tier. So you could see a world where the free tier of Google is maybe less good results or includes more advertisements, and maybe a paid tier has pure results.
Right. Good. Well, we've got plenty to do next week. We'll continue this discussion. We'll also work from page 15 forward, try to knock off another 5 pages next Wednesday. In the meantime, everyone be well and stay healthy and take care, everyone. Bye-bye.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.